In our coaching room, there was a really, really cool comment that I wanted to share with everybody. The comment was from Jay here. Buying what goes against you. Sounds like something other traders say don't do. Cut your losers quick, they say. However, I got to see just how good that change in my trading approach performs. Making that decision on a total amount and laddering in as it goes against is a game changer for me. So what Jay is saying here really summarizes the approach that I teach. So I want to go over that, and then I will get a couple of questions about just the outright market and line in the sand. So we'll talk about that. But this is the difference, a big difference in how I approach the market and how others approach the market. I do not use stops, okay? And that might sound scary, but it's actually a more conservative approach to the market than using stops. So let me explain. So what Jay is saying here is when we look to do a trade, and so let's use the example of AMC. We're not using stops. That sounds scary, but again, just to repeat, it's more conservative than using stops by not using stops. And so what Jay is saying here is using an example like AMC. AMC was shared December 9th. So if we look at December 9th, that would be right about here. This trade went against us, right? So right away it goes up, fine. This sucks, right? Whenever you're long a name and it goes against you, it sucks. If you're using a stop, your stop's going to get triggered. But the reason why we're in AMC is because they're changing their model to subscription-based model and trying to be innovative in the movie theater space. If they're successful, which they are successful right now, and they're trending to that, to succeed in changing the way they do movie theater tickets, there's a possibility that they might be valued, trade with a valuation of a subscription model rather than a traditional movie theater. So this move right here, I don't know how else to tell you this. It has nothing to do with AMC. Nothing. Nothing. Like literally, this move right here is beta. That move right there is only because of the S&P move. Okay? So here is this. And so something that I'm always telling you is when the market goes down, everything gets dragged down. But if you're in a name, and this is just an example of AMC because I want to, explain Jay's comment because eloquently kind of summed up the difference between how we trade versus how others teach. I want you to, when I talk about beta, this move is beta. This move is only happening because the overall market is getting dragged down. Once it stabilizes, well, naturally, AMC stabilized as well, and then now it's just trading on its own, starts rallying. But if you were just trading with stops, you would get stopped out of all your good positions that you did a whole bunch of research on just because the market was getting hit. And the way that we do this without getting stopped out is we find good places to buy options and we ladder into those trades. So instead of just buying AMC, what I suggest and what I teach, and I really do with all my heart think this is the best way to trade, is for any size account, for any kind of trader, because you know exactly what your risk is. So the outright trader could buy AMC at 15, buys 1,000 shares, and stops yourself out at 14. 14 stops yourself out, you lose 1,000. Okay? But how we teach is, you lose $1,000 here. if we go back on AMC, buy 1545 calls for 95 cents, buy 1545 calls for 95 cents. The first time you do this trade, risk $300. We want to ladder in. Okay, so we want to risk, 333, 333, 333. And by doing that, instead of being like, oh shit, the market's going against us when this happens, instead, we're buyers. We're looking at that as opportunity because we did our work. We know this is an example of a trade that we want to invest in. So we're going to make a commitment to risk $1,000 on this trade and stay in it for as long as we can. So the advantage of doing this is you get more time, okay, because we're laddering in. It lets you stay in the game more. It's a fixed amount of risk. You know you can never lose more than you invest or than you bet. Here, fast market, you might get stopped out at 1370, and then you don't lose $1,000. You lose 30% more than you expected to lose because you're in a fast market. This can't happen. You can never, ever, ever, ever lose more than you make a conscious decision to bet, to invest. And you can do it with $100, $1,000, $10,000, $100,000. It doesn't matter. So that's where we want to get to. And I've seen this comment from a lot of people. Jay just eloquently did it most recently. But that's the game changer, because you're staying in a trade rather than if you're just doing an outright with stops. I mean, how many people have put a stop in the market and then the market gets close to it and then you go and change your stop? Has anybody ever done that? Has anybody ever put an order in the market gets close, and then you convince yourself, you know what? I like it. I think I'm right. I want to stay in the trade. Let me move my stop. Okay? You can't do that. Once you make a conscious decision to put an order in the market, if it hits your stop that you put in earlier, that was a decision you made. You can't make a reactionary decision and overrule something that you had so much time to think about and consider. It doesn't make sense. John, that's exactly correct. What you end up doing is you change the narrative. All of a sudden, a trade becomes an investment, and then you put it in your IRA, and now you're stuck with it forever until it comes back. Okay? Does that make sense, guys? Does anybody have any questions about that before I move on and get to the other questions? I got 40 of you on here. Can I get some whys? Can we get like a proof of life out there? Helps me to see who's paying attention. Can I get a Y if you're paying attention to me? And an N if you're not paying attention?